Welcome to the deep dive. Today we're looking at EIH Limited, the Oberoi Group, a real giant in luxury hospitality.
Absolutely.
We're going to explore how they're doing lately, their plans, what makes them tick in that high-end space, especially with everything going on globally.
Yeah, there's quite a bit to unpack there.
Let's dive right in. So, first glance, Q1 of FY26 looked operationally really strong for EIH. Good demand, strong pricing. Revenue and EBITDA numbers looked impressive.
They did. Operationally, it was a very robust quarter. Pricing power was definitely there.
I sense a but.
Well, yeah, the but is the bottom line, the net profit. It was significantly depressed.
Okay, why? What happened?
It boils down to a one-time exceptional charge, a big one. Rupees 110 crore. It's related to the Mashobra property, Wildflower Hall. There's a court ruling back in June 25.
Ah, the Mashobra situation. That's been ongoing, hasn't it?
It has. But the key thing here, and this is important for looking ahead, is management seems pretty confident this is it, the final exceptional hit from Wildflower Hall. So it kind of removes that lingering uncertainty.
Okay, that clarity is definitely valuable. So if we mentally set aside that one-off charge, what do the Q1 numbers actually show about the business itself?
Right. If you look past that, EIH actually delivered its highest ever Q1 revenue and EBITDA on a consolidated basis, which is saying something.
Highest ever. Okay, give us the specifics.
Sure. Consolidated revenue from operations grew 9% year-on-year, hit rupees 573.6 crore.
Solid growth.
Yeah. And EBITDA, that was up 16% year-on-year to rupees 195.3 crore. Margins landed at a healthy 32%.
Pretty good margin.
Very good. Now, the profit after tax, the PAT, that's where you see the hit. It was rupees 36.9 crore, which is down 62% compared to last year. But again, that's almost entirely due to that rupees 110.5 crore exceptional charge.
Okay, so the underlying operation is humming along nicely. What about standalone? Similar picture.
Very similar. Actually, even a bit stronger on the growth front. Standalone revenue was up 15% year-on-year to rupees 518.8 crore.
15%? Wow.
And EBITDA surged 28% year-on-year to rupees 193.5 crore. Margins there improved too, from 30% last year to 34% this Q1.
Impressive margin expansion.
It is. But same story with PAT, rupees 36.4 crore, down 57% year-on-year. Again, because of that, rupees 110.3 crore exceptional item related to Mashobra.
Right. So Mashobra was obviously the big elephant in the room for the financials. Were there other things impacting the numbers in Q1?
Yeah, a few other moving parts with Mashobra, that rupees 110 crore charge. It covered things like not getting the expected equity value plus a 50% advance against that equity.
Okay.
Interestingly, an earlier provision they'd made for user fees, about rupees 86 crore, that was actually reversed. The court didn't rule on it specifically. EIH is still running the hotel for the state government, by the way, and they hope to keep doing that. But the whole discontinuation, did shave a bit off the top-line growth compared to last year.
Makes sense. Anything else?
Yep. Two other things. The Oberoi Grand in Kolkata, their iconic property there, was closed for renovation. That's 209 rooms offline.
Big impact, I imagine.
Yeah. They estimated it knocked about rupees 22 crore off the Q1 revenue.
Okay.
And then there's the Oberoi Airport Services in Mumbai. They stopped the lounge business there from the second half of last fiscal year. So that impacted Q1 FY26 revenue by about rupees 28 crore. But interestingly, the flight kitchen business did really well, so it seems to have offset the lounge closure impact at the EBITDA level, even if the revenue took a hit.
Okay, so some operational drags, but the core hotel business, minus Mashobra's financial hit, seems strong. Let's talk strategy. How are they actually performing out there in the market, especially with things like, geopolitical tensions?
Right, and this is where it gets really interesting, actually. Despite those headwinds you mentioned, Operation Sindoor, the Middle East conflict, which definitely impacted sentiment, particularly in northern India, the underlying demand for luxury hotels seems surprisingly resilient. Q1 saw strong activity, and they anticipate good demand for the rest of 2025.
So they managed to perform well despite those issues.
Exactly. The EBITDA performance shows that strength.
Yeah.
Let's look at the key metrics for their hotels, including the ones they manage. RevPAR revenue per available room grew a really solid 16% year-on-year.
16%, that's significant.
It is. Went from about INR 9,800 to over INR 11,350.
And how did they achieve that? Occupancy or rates?
Mostly rates. The average room rate, or ARR, jumped 18% year-on-year. Occupancy was pretty much flat, around 70%.
Ah, so it's a pricing strategy.
Definitely. EIH is really focused on driving ARR because, think about it, a bump in the average rate flows much more strongly to EBITDA, to the bottom line, than just squeezing in a few more guests at lower rates.
Right, the costs are relatively fixed for that room.
Precisely, especially in luxury.
Right.
So getting higher rates is incredibly efficient for profitability. You see this particularly in their leisure hotels. They operate at much higher ARRs, often over INR 50,000, sometimes even hitting INR 60,000 plus in the peak winter months.
50 to 60,000 rupees a night. That's serious luxury. So this focus on price leadership, how does it position them against competitors?
It positions them very well. They've consistently been the RevPAR leader compared to their competition. They maintain about a 20% lead on the Revenue Generation Index, the RGI.
RGI, remind us what that means again?
Basically, it measures a hotel's RevPAR against its competitive set in the market. A score over 100 means you're getting more than your fair share of revenue. EIH consistently being 20% ahead means they're significantly outperforming their luxury peers in generating revenue from their rooms.
So clear market leadership there.
Yeah. And it's not just domestic. Their international property, Mauritius, Egypt, Marrakesh, also showed strong performance. RevPAR grew 22% year-on-year internationally. It really underlines their global standing in luxury.
Very strong operational story then. Looking ahead, what's fueling this confidence? You mentioned the India story.
Exactly. Management sees a tremendous opportunity in the premium segment, and it's all tied into India's growth narrative. There are several key drivers.
Like what?
Well, first, demographics. You've got an 11% rise in ultra-high net worth individuals. These are people actively seeking the kind of exclusive experiences EIH provides.
More potential top-tier customer.
Right. Then there's inbound tourism. Forecasts suggest about 15% growth in FY26. Better global connectivity helps, plus India's higher profile after G20.
Makes sense.
And it's not just foreigners. Domestic tourism is booming. Corporate travel is picking up, including MICE meetings, incentives, conferences, exhibitions, spiritual tourism, big live events, culture and heritage travel. It all adds up.
A lot of different demand streams.
Absolutely. And underpinning all of this is infrastructure growth, new airports, better highways, making travel easier and more appealing across the country.
So if you're listening to this, how should you think about these big trends impacting a company like EIH?
It means the fundamental demand for what they offer, top-tier luxury, unique experiences, impeccable service, is on a strong upward trajectory. They're positioned right in the sweet spot to capture this growing demand, turning these macro tailwinds into actual revenue.
And they're planning to capture it with more hotels, right? Talk about their expansion plans.
Oh, yeah, they're not sitting still. They have this ambitious Vision 2030. The goal is basically to double their current room count.
Double. Wow.
Yeah. The pipeline has 25 new properties, adding over 2,000 keys, 2,033 to be exact, by the end of the decade.
Where are these new hotels going to be?
The vast majority, about 85% or 1,750 keys, are domestic, tapping right into that India growth story we talked about. 8 will be owned or joint ventures, giving them more control, and 17 will be managed properties.
Are these plans on track? Any delays?
There have been some delays on a couple of the managed projects like Oberoi Dahabeya in Egypt and Oberoi Diriyah in Saudi Arabia. That's often the case with managed properties. You know, EIH has less direct control over the third-party owners' timelines. But management stressed that these delays don't affect their own expansion plans, the owned properties. Those are moving ahead aggressively. And interestingly, they also secured a major deal in London, a 125-year lease for an Oberoi hotel from the Grosvenor estate. That's a huge long-term bet on a key global city.
125 years, that's confidence. But funding all this, doubling the room count, prime London property, does EIH have the financial strength for this?
That's a crucial question, and the answer seems to be yes. They have a very strong balance sheet. As of the end of June 2025, they were sitting on a cash pile of rupees 11,150 crore.
$1 billion plus in cash. That's a solid war chest.
It is, and they expect to generate significant cash from operations to somewhere around rupees 1,700 to 1,800 crore over just the next 2 years.
So they can fund a lot of this internally.
That's the plan. They seem well positioned to self-fund a large part of this expansion, reducing reliance on debt. Strong financial footing.
Okay, sounds positive overall, but no business operates in a vacuum. What challenges does EIH see on the horizon? What are the bumps in the road?
They definitely acknowledge factors beyond their control. Geopolitical stuff, like we mentioned, Operation Sindoor, the Middle East situation. Those did cause temporary dips in occupancy, so especially up north and in places like Egypt and Marrakesh. You can't really shield yourself completely from those kinds of external events.
Sure. What about industry-specific challenges?
Yeah, there are those too. Finding and retaining skilled human resources is a big one across the hospitality industry. Partly a hangover from COVID layoffs, maybe?
The talent crunch.
Exactly. Then there are the usual hurdles like delays in getting approvals and permits for new hotel openings. That can slow things down. And land costs, especially in prime city spots, remain very high. Sometimes you need those mixed-use developments just to make the numbers work on expensive land.
So how does management frame these challenges? Do they seem worried?
Their take seems realistic. They know there will be ups and downs, geopolitical risks are always there, but they really emphasize focusing on the positives. The strong economic backdrop in India, rising disposable incomes allowing people to spend on luxury, and just the fundamental demand drivers. They see the challenges as things to navigate, not roadblocks that derail the whole strategy.
All right, let's pivot to valuation. Investors always want to know about the numbers. How is EIH valued, and what's the earnings outlook?
This is quite an interesting part of the story. If you look at their financial trajectory, it's pretty compelling. Revenue is projected to grow strongly from about rupees 2,000 crore in FY23 to an estimated rupees 3,300 crore by FY27.
Significant growth, driven by rates and new hotels.
Exactly, that combination.
Right.
And EBITDA is projected to grow even faster, showing operational leverage. From around rupees 600 crore in FY23, with 30% margins, they're expected to hit rupees 1,200 crore by FY27.
Doubling EBITDA.
Yeah, and look at the margins potentially reaching 37.5%. That's really top-tier efficiency for the industry.
And the net profit.
Following suit. Net profit more than doubled from FY23 to FY25, going from rupees 315 crore to rupees 740 crore. And forecasts put it near rupees 950 crore by FY27. This translates directly into earnings per share, the EPS. It's projected to basically triple from around rupees 5 in FY23 to over rupees 15 by FY27.
Tripling EPS in 4 years. That's strong earnings growth. How does this impact the valuation multiples, like the PE ratio people look at?
This is where you see that idea of earnings catching up with valuations.
Yeah.
Back in FY23, the stock traded at a very high PE multiple, almost 80 times.
80 times? That's steep.
It was. The market was clearly pricing in a lot of future growth and recovery.
Yeah.
But as the earnings have actually come through, as they've grown so strongly, those multiples have naturally come down or compressed.
Okay.
By FY25, the PE was around 34 times based on actual earnings. And looking ahead, based on those FY27 projections, the forward PE drops to around 26.4 times.
Much more reasonable.
Exactly. It's like the company's growing into its valuation. The potential the market saw is turning into actual, tangible profit growth, making the current valuation look much more grounded relative to future earnings. It's a strong narrative.
So wrapping this all up, what's the core takeaway on EIH Limited?
I think the main point is that EIH really stands out as a resilient, high-quality player in luxury hospitality. They're executing well on their pricing strategy. They have ambitious but well-funded expansion plans, especially domestically, and they're riding favorable market trends tied to India's growth. Getting that Mashobra financial issue definitively settled is also a big plus, removing uncertainty. They seem very well positioned.
Definitely a lot going on there. It leaves me thinking, as India's luxury market keeps evolving, how might EIH's focus on maximizing rates and this big expansion actually reshape what high-end travel even looks like? And could it open up new opportunities beyond just building hotels, maybe in other luxury services? Something for you to ponder. And before we sign off, just a quick but very important reminder. We are not SEBI-registered financial advisors. This discussion is for informational purposes only. If you are considering any investment decisions, please make sure you consult with a certified financial advisor.